The following analysis is for educational purposes only and does not constitute financial advice. DTE Energy has secured 2.4 gigawatts of new hyperscale data center load from Google and Oracle. In the world of regulated utilities, this volume of high-density, 24/7 demand creates a massive, predictable expansion of the rate base. But capturing that revenue requires DTE to execute a $36.5 billion capital expenditure plan over the next 5 years. To build the grid of the future, they have to spend at a scale that challenges their existing financial structure. This creates an immediate drag on current shareholders. DTE expects to issue $500 million in new equity annually through 2028, just to keep the build-out funded without compromising its credit rating. To determine the actual value of a share under these conditions, we are reconciling 21 different valuation models against the specific regulatory data found in their recent filings. The central question is whether a legal monopoly with guaranteed demand can overcome the mathematical pressure of its own expansion costs. We begin with the first tier of the valuation grid, cash flow models. The standard discounted cash flow model places DTE at $142, while the unlevered free cash flow model comes in slightly lower at $140. Both models are being weighed down by the timing of the company's investments. DTE is deploying cash so aggressively in the near term that the present value of those future data center earnings is being offset by today's spending. Our models for free cash flow to the firm at $135 and free cash flow to equity at $138 reflect the same pressure. They are reacting to a projected $6.8 billion capital budget for 2026. The adjusted present value model provides a different perspective at $145. By unbundling the business value from its financing, we see how DTE's high debt levels provide a significant tax shield that supports the bottom line. Tier 2 shifts to dividend and income models. DTE's 56-year history of payouts acts as a stabilizing force here. The dividend discount model reaches $155, while the Gordon growth model settles at $150, the multi-stage DDM at $152, and the residual income model at $144 provide more nuance. They price in a temporary growth spurt through 2030, before assuming the utility returns to a more traditional, slower terminal growth rate. However, the economic value added model drops to $130. Because DTE requires such a massive asset base to function, the capital charge on that infrastructure effectively consumes a large portion of the operating profit. The data suggests a conflict. DTE's dividend history provides a high floor for the stock, but the sheer volume of capital currently being consumed by the grid upgrade is eroding near-term cash efficiency. Moving to Tier 3, market multiples, we see how the broader sector views the company. Comparable company analysis lands at $148, while precedent transactions, looking at what others have paid for similar utilities, hits $160. DTE is currently trading at a forward PE ratio of 19.5. That is a noticeable premium compared to the utility sector average, suggesting the market is already pricing in the growth potential of the Google and Oracle contracts. Price to book sits at 120. While the EV to EBITDA and EV to sales models come in at 146 and 140, respectively. Tier 4 examines the balance sheet. The book value model provides the lowest valuation at $105. This reflects the accounting reality of legacy infrastructure, like older coal facilities, that have been heavily depreciated over decades. There is a wide gap here. While the book value is low, the replacement cost sits at $170. Rebuilding DTE's entire network in today's inflationary environment would be significantly more expensive than the current market price suggests. Finally, Tier 5 looks at real options. At $165, this model attempts to price in the possibility of further unannounced data center deals and the high margin potential of their renewable natural gas business. Market participants are clearly focused on the future tech-driven demand, largely looking past the physical depreciation of the utility's legacy equipment. Beyond the models, the regulatory filings highlight specific friction points. Recently, the Michigan Public Service Commission approved only $242 million of a requested $574 million rate increase.
This gap between what DTE requests and what regulators allow is a persistent risk. Additionally, the company is facing an expiration of tax credits for its renewable natural gas business in 2029, which will remove a high-margin revenue stream. Looking at the debt tables, we see over $3 billion in long-term obligations. To keep their debt-to-equity ratios within target, DTE is now issuing subordinated debt, signaling that their balance sheet capacity is becoming a primary constraint on growth. Furthermore, state regulators have capped the company's authorized return on equity at 9.9%, even as DTE argued that 10.75% was necessary to attract capital for their grid modernization. However, the filings also show significant operational momentum. The company has locked in 2.4 gigawatts of load, and they have already secured $200 million in pre-approved funding for grid modernization. They are also managing the transition away from coal with high capital efficiency. By repurposing the existing Bell River site for natural gas, they are avoiding the multi-billion-dollar expense of a new greenfield build. Operational performance is also working in their favor. By reaching top quartile reliability and power restoration, DTE is building the political capital necessary to navigate future regulatory reviews. The filings reveal a constant struggle. DTE has the customers and the contracts, but they are operating within the strict mathematical limits of a state-monitored financial structure. We can ground these 21 models by applying the philosophies of three legendary investors. We start with Ben Graham. For a deep value purist, DTE fails. The Graham number for this stock is roughly $41. Graham's criteria were designed to find stocks trading at a deep discount. At nearly 20 times earnings, DTE is priced far too high for his defensive investment strategy. Peter Lynch also issues a failure. His focus on growth at a reasonable price is triggered by the company's PEG ratio. A 19.5 PE against only 7% earnings growth results in a PEG of 2.7, well above his preferred threshold of 1. Warren Buffett, however, offers a mixed pass. While he typically avoids companies with massive ongoing maintenance costs, he values businesses with wide economic moats and regulated returns on equity that are protected by law. To these investors, DTE is not a bargain or a fast grower. It is a moat-driven play for those who prioritize the stability of a legal monopoly over immediate cash efficiency. After synthesizing all 21 models, the average intrinsic value for DTE Energy lands at exactly $140.71. With a current market price near $148, the stock appears slightly overvalued. The market has fully embraced the tech-driven growth narrative, but it has not yet fully accounted for the financial drag of the capital plan. However, the company's economic moat is expanding. It is built on efficient scale, the fact that building a competing power grid is economically impossible, and a significant cost advantage through their existing infrastructure. The addition of 2.4 gigawatts of data center load significantly strengthens this moat. These contracts lock in high-volume, long-term revenue that would be nearly impossible for any competitor to displace. Furthermore, these contracts provide a subsidy for the broader grid. By adding $1.7 billion in benefits, these data centers help manage costs for everyday residents, which creates the political breathing room DTE needs to continue its rate-based growth. The final verdict is a matter of timing. DTE is a capital-intensive legal monopoly attempting to outpace its own regulatory restrictions. They are deploying capital at a rate that currently exceeds their organic cash generation, placing the burden on the investor to weigh the long-term utility against the immediate dilution. The paradox remains: the more they grow, the more they must spend to stay ahead.